Hello, Business 201. This accounting video demonstrates the 11 transactions that accompany the illustrative problem of your Warren, Reeve, and Duchak textbook that begins on page 25. The scenario for this particular case is that we are doing the business for Cecil Jameson, an attorney at law. It is a proprietorship that is owned and operated by Cecil Jameson, and the transactions will be recorded for the month of July. To begin the month, Cecil has been operating for a while. The business has cash of $1,000, accounts receivable of $3,200, supplies of $850, and land of $10,000. So beginning the month, the sum of these assets give the balance sheet a total for assets of $15,050. The balance sheet also reports $1,530 of accounts payable, a liability, and it reports that Cecil Jameson has contributed $13,520 to his business. So the liabilities of $1,520 plus $13,520 of assets, or of contributed capital, total the $15,050 liabilities plus owner's equity. This particular spreadsheet has three areas to it. The yellow section represents the balance sheet. The green section represents the income statement, which shows the detailed increases, revenues, and the detailed decreases, the expenses that the business has incurred. Anytime income changes, the earned capital changes. So the income statement represents a detailed increase and decrease of the company's earned capital. The third area is the cash flow statement. Anytime cash would increase or decrease, the cash flow statement categorizes those cash flows in terms of operating activities, investing activities, and financing activities. We can see that in the cash flow statement below. Now, this spreadsheet represents the records of the company. The main goal of accounting is to produce financial statements, which represents a summary of the activity that happens in the business. We will take the totals in the green area to create the income statement. We will take the totals in the yellow area to create the balance sheet, and we will assemble the values in the blue area to create the statement of cash flow. Okay, let's get started with the 11 transactions that are shown here for Cecil Jameson for the month of July. Transaction A is that Cecil received cash from clients in the amount of $2,928. So we will enter an increase in cash, $2,928, and because Cecil Jameson earned the right to bill his clients, he has earned fees. So we will also increase fees $2,928. Now, fees represent a revenue, and when revenues increase, we should also see a corresponding increase in net income. Net income represents the detailed increases or decreases in the company's earned capital. So we should also see a corresponding increase in the capital for Cecil Jameson. Since there was a cash increase, we must categorize that cash change in the statement of cash flows. In this case, collecting cash from customers represents an operating activity. So we will label $2,928 as an operating activity. Second transaction, Cecil Jameson paid creditors on account $1,055. Paying cash reduces cash, so we will enter in a negative $1,055 under cash. Since Cecil paid creditors, Creditors represents accounts payable. Paying off a creditor means that we have reduced the balance in accounts payable, so we will enter $1,055 negative amount under accounts payable. No revenues or expenses were incurred, so no entry goes to the income statement, but because cash decreased, we will show a outflow, a negative amount, in the statement of cash flow. Paying creditors represents an operating activity, so label this amount operating. Third transaction, received cash from Cecil Jameson as an additional investment, $3,700. So in this transaction, like the previous ones, cash has changed. We will enter a positive amount to show the increase in cash. But this time, the business did no action to earn that cash. It was simply a gift from the owner, Cecil Jameson, so we will increase the contributed capital account $3,700. The balance sheet balances, so that means in this case there is no effect on the income statement. But since cash increased, we will show an increase in cash flow, but because it came from the owner and not from the earnings process, this would represent a financing transaction. Let's look at transaction D. Paid office rent for the month, $1,200. In this case, cash went down because amounts were paid, and the amount was for office rent. So let's excuse me, move to the column that shows the expense office rent. In this case, we will enter a negative amount for expenses because expenses reduce net income and also reduce owner's earned capital. So the expense decreases net income, and we should see a corresponding decrease in earned capital. Because there was a cash decrease, we will also see a cash outflow in the statement of cash flows, and paying rent is an operating cash item. Transaction E says clients were charged for legal services in the amount of $2,025. Clients were charged, but they haven't paid cash yet. So instead of having cash, the business has a claim, which is called an accounts receivable. So enter a positive $2,205 in accounts receivable. Because Cecil Jameson cannot bill clients unless fees were earned, we will also increase fees earned by the same amount, $2,205. The increase in fees earned increases income, and the increase in income is also reflected in the earned capital, $2,205. As you can see, the balance sheet balances. Now, as I'm going through the various transactions, note that as I enter a transaction, the financial statements are updated accordingly. In transaction F, the company purchased supplies on account. That means that the company would have increased its stock of supplies. So let's increase the asset supplies $245. And it promised to pay for those supplies later. The promise to pay later is an account payable. So increase accounts payable $245. No revenue or expense was incurred, and because there was no increase or decrease to cash because of this transaction, there will be no effect on cash flow. Transaction G. Excuse me. Cecil received cash from clients on account for $3,000. Pardon me. So cash increased $3,000. Now, the exercise says that the cash The exercise indicates that this was paid on account, which means that customers that owed Cecil Jameson from past services have now paid up. So we will decrease accounts receivable, the amount that's owed by the customers. No effect on the income statement, but because cash went up, we will show an operating cash flow in the statement of cash flow. In transaction H, Cecil received an invoice for paralegal services from an outside company called Legal Aid, and this was for the services that Legal Aid provided in July. Cecil, though, will not pay this amount until August. So Cecil has incurred an expense for legal services of $1,635. So we will enter a negative amount in paralegal expense, $1,635. But because Cecil will not pay for this until the following month, Cecil will have an account payable increase of $1,635. Okay, the expense decreases income, and this decrease in income will be reflected in Cecil Jameson's capital account. Because no cash was received or paid, there is no effect on the statement of cash flow. In transaction I, Cecil Jameson paid a variety of expenses. So let's just log those particular expenses. Utilities expense were $850. Answering service expense was $325, and miscellaneous expenses were $75. We will enter negative amounts for each of these expenses because expenses reduce income, and income in turn will reduce owner's capital. In this case, the sum of the three expenses equal $1,250, and that's the total that we will bring as a reduction to contributed capital for Cecil Jameson. No cash was received or paid, so no effect on the cash flow statement. In transaction J, the cost of supplies at the end of the month was $980. Let's examine the supplies account. The company had $850 of supplies at the beginning of the month, and then it bought another $245, so the company had accumulated up to $1,095 of supplies. Now, at the physical count, the company discovered that there was less supplies than they had at their high water mark. There was only 980. So, if we compare the high water mark of 1,095 and deduct the amount that's left, the difference, in this case 115, must have been the amount that was used up. So once we enter a negative $115 in supplies, the deduction of 115 brings the supplies asset account down to the physical count at the end of the month, $980. A cost that is incurred or an asset that is used up is an expense. So the reduction in the asset supplies will result in the company incurring supplies expense of $115. So enter 115 under the supplies expense. That expense reduces income by $115, which will in turn reduce earned capital $115. And finally, at the end of the month, Cecil withdrew $1,000 in cash from the business for his personal use. So the cash decreased. In this case, Jameson would have withdrawn the money and the business didn't perform a service or receive a good, and so this is logged in as a drawing against the owner's claim on business assets. Because there was a reduction in cash, we will show a decrease in cash flow, and because dividends or drawing is a part of contributed capital, we will consider this a financing activity. Okay, we have taken care of all the transactions, and we do happen to note that the balance sheet doesn't balance. And so that means that we have forgotten something somewhere along the line. How can we find this error? Well, what we need to do is to examine each transaction and determine where the balance sheet does not balance. When we do that, we find that in transaction I, we forgot to make an entry in the balance sheet because we only have the decrease in capital, but we have no change on the asset side. So when we examine the transaction, it says that the company paid wages of these items and the total was $1,250, and so we should have reduced cash by $1,250. That $1,250 of cash would be an operating cash outflow. Now, the balance sheet balances at $19,508 for assets and $19,508 for liabilities and owner's equity. At this point, we are ready to prepare the financial statements. Let's do what's important for the owners first, the income statement. So we will just put into fancy form the revenues, $5,133, and list the individual expenses and use the column totals as the captions that we would have on the income statement. So transferring $1,635 for paralegal expense, $1,200 for rent expense, $850 for utilities, $325 for the answering machine, $115 for supplies expense, and $75 for miscellaneous. There is a total of $4,200 of expenses. $4,200 of expenses from fees of $5,133 gives net income of $933. Now, that net income is for the benefit of the owner, so net income increases the equity of the business, and it is transferred to the statement of owner's equity. The statement of owner's equity merely shows what the owner's claim on the business was at the beginning of the month, the increases and decreases, and what the owner's claim on the business would be at the end of the month.